Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome Victor Menasce. Hi, Victor.
Mike, great to be here.
Thank you very much for joining. I'm honored to have you on the podcast. And the way we connected is through Alina, who joined us as head of investor relations, and she said you are her mentor.
Yes.
So I was very impressed when she said that, and I thank you for having on the podcast. And you come from the northern neighbor. You're coming from Ottawa, Canada. And you have a Real Estate Espresso Podcast, and you're a developer mostly in multifamily, but you also have other projects. Did I miss anything important? And before you even do that, family, could you tell folks a little bit about your family, wives, cats, pets, kids, all of the above?
Only one wife. One wife, cat, 5 children, all grown up at this point. And we live here in Ottawa, which is an amazing place to live. We're active in investing in multiple different communities across North America and Canada. And our passion is sailing. We love to spend our summers on board our boat in Europe.
That's awesome to hear. As I like to say, most people in the investing world want to see smooth sailing, and you're taking that into the real world. So smooth sailing is always a journey of it's obviously rough seas are not fun, but so let's talk a little bit about sort of what are you active in today? What kind of projects? What seems to be the opportunities? We live in this sort of post-COVID world, in this weird economic expansion. Everything seems to be on fire. All the markets, except for New York City, where I live. It's one city in the whole country that's in a strange funk. But outside of New York, everything seems to be kind of cranking. And so what are your thoughts?
Well, I wouldn't quite say post-COVID, although that's certainly the case in places. I mean, where I am right now in Ottawa, Canada, we're in one of the strictest lockdowns and at the highest peak of infections so far in the pandemic, as has been mirrored in parts of Europe. You've got the U.S. in decline, Israel, the U.K., Chile, but in pretty much so many other countries in the world, the pandemic is still raging full force. So it's the recovery is going to be spotty, but clearly everybody's looking past the end of the pandemic, certainly from an investment standpoint. We're active in multiple different communities. Like you said, we're primarily multifamily. We're active in assisted living. I've got an 80-bed facility that's scheduled to open in the next 30 to 45 days. We're active in condo development. Active.
Where? What markets?
Here in Ottawa, Canada, actually. We've got a 95-unit condo project that we're working on right now. And we are actually looking, well, more than looking, we're very actively involved in a food and beverage project. We came across an opportunity to lease a 26-acre farm right in the core of the city, and the plan is to open a farm-to-table restaurant in the core of the city, something that there's nothing like it anywhere in town, and we expect it's going to be certainly a unique property in our home market, if not perhaps in Canada. I wouldn't say North America wide. In New York, you've got Blue Hill in near Washington Square Park, which is a farm-to-table restaurant. It's really one of the, let's say, the benchmarks in the world of that type of product. But everyone we talk to is, when we tell them the story about this particular project, they are captivated by it and saying, when can I eat there? I can't wait. So we've got a breadth of different things underway. Oh, I guess the other thing, of course, a big part of what we're doing is we're very active in residential subdivision development. We have 4 or 5 of those projects underway right now as well.
Also in Ottawa?
No, we've got in Boise, Idaho. We have a couple of those, Asheville, North Carolina. So we're active in multiple different markets doing subdivisions.
Yeah, that's really cool. So first of all, the urban farms welcome most cities. One little bit of green, take away some of the polluted air, and turn it into some good fruits and vegetables. And yeah, forgive me, I didn't mean to say that we are over COVID. Yes, it's just more of a pandemic hit. Now we are kind of in the midst of the pandemic, but we are sort of, the world is going through some level of vaccination. Obviously, some countries are ahead of the others,
Right.
and building herd immunity, and it will take some time. And unfortunately, like you said, some countries are still struggling at the a local peak of the infection, and so our thoughts and prayers, obviously, with people of Canada and Ottawa, and you're struggling in other countries where the pandemic is still raging. So that aside, the world is seeing kind of the light in the tunnel, that we're building herd immunity, people getting immunized, but the real estate seems to be doing well. Like all your ground up developments in multiple markets are probably good projects. So so what do you see? Just kind of, I mean, the market is sort of booming. We see asset price inflations. I mean, you go into the project with one pro forma number, and you finish the project hopefully with a better pro forma number as these prices continue to climb. So what are you seeing? Is this a trend that's going to continue most of this year, go into 2022? Are you planning to do a number of current starts with the delivery, a year from now, however long it takes? Just curious.
We are being very selective in our projects. We're looking at those places where there is a sustained trend of net influx migration. We want to see that trend predating the pandemic. We don't want it just to be a short-term pandemic-driven phenomenon. So we want to see that kind of sustained trend. And when the fundamentals are there, fundamentals of job growth, fundamentals of population growth, a sustained mismatch between demand and supply, that creates those market conditions for continual upward pressure on prices, which is what you want to see. And so it's in those communities, in those submarkets specifically, that we're investing. Some people, they look at their definition of a bargain, and I know there are people that are, for example, investing in Detroit and Cleveland, and nothing wrong with those cities, but those cities have from time to time lost population. And for me, that just violates one of my fundamental rules. The definition of a bargain is not, can you get something that's maybe cheaper than construction cost? It's, what is it really worth? Is there upward pressure on demand? And if that doesn't exist, then I won't invest. That doesn't mean someone else's criteria, but we won't invest in that. So we're very focused on those areas where there is that upward pressure, and when the fundamentals are there, and we put together the right boots on the ground team. That's the other key. Then we'll look at specific opportunities, and it's got to be multiple opportunities. It can't just be a single one and done type scenario. We have to see a stream of investment in that locale for a sustained period of time. Otherwise, it's not worth making the investment to put a team in place.
Yeah, great comments. I love the first. Let me just provide a little commentary. Your wisdom reminds me what Warren Buffett said. Like, you're basically investing in, like Warren Buffett says, not quoting him exactly, but I think the essence is that I would rather buy a great company at a fair price than a fair company at a great price.
Right.
The same concept applies here. You'd rather buy great real estate for long-term basis and pay a fair price for it than get a bargain in a market that you have long-term fundamentals not supporting. So you're doing classic Warren Buffett investing versus kind of let me go look for the Salvation Army deals and or discounted deals. Unless you flip them quickly and you get out, you don't know what's going to happen in the future. While in these growth markets, you are, the trend is your friend. Long-term trend is your friend. That's the first comment that kind of I had. And then the second comment really like, and I just capturing this wisdom, and I'm going to follow up with a question, is that when you make an investment, especially again, you're Canada based, and I'm sure you have great operation in multiple markets, but the challenge is it takes time, energy, and effort to develop an operation in a given city, especially when you're building. It's construction, it's materials, it's the labor, it's the infrastructure, it's the suppliers, everything else. And it's a lot of heavy lifting. So you better have more than one opportunity for this to make sense. So here's a question. Do you try to find more in the markets you already have presence, or you're exploring new underserved markets and thinking, hey, maybe this is another great demographic trend, population trend, everything is trending to go into that market, and you're open to enter that market, understanding that there is, it's a more heavy lifting.
We're open to entering other markets, but again, it's got to meet those fundamental rules, because it is going to be an investment to put a boots on the ground team in place. And the other thing is, of course, it's got to have sufficient scale, because, we're interested in working with that upper echelon of the industry. We're not interested at all in working with the two guys in a pickup truck category of operators. It's got to be that upper echelon. So we have to see sufficient scale. We've got to see sufficient size of opportunities, absorption, demand, all of those things. There's got to be something happening. So we love markets, for example, like Houston, Austin, Asheville, North Carolina. We love Boise. We love Spokane, Washington. We love where else? Nashville. We're not doing anything in Nashville right now, but I love Nashville. You've got 108, 110 people a day moving into the Nashville market. That's significant growth. That's 38, 40,000 people a year. It's pretty decent growth on a population base of under 1 million people. So that's a very nice growth scenario for that market. And we've seen it reflected in prices over the past 8-9 years. The people that have been active in those markets have been handsomely rewarded. And at the end of the day, we talk about it as price inflation. There's really a number of things that come into play. We're looking for a higher dollar value if the dollar is your point of reference, but there's different parts of that appreciation. There's the forced appreciation, the value that you've added to the product. There is the market appreciation that is the result of demand exceeding supply. And then there's price inflation, which is the devaluation of the dollar. At the end of the day, when we're buying hard assets, real estate assets, we're leveraging them hopefully responsibly. What are we doing? We're shorting the dollar. We're saying the dollar is going to be worth less in the future than it is today. That's a pretty safe bet. So what happens when the dollar gets devalued? Well, people on fixed income, their buying power gets wiped out, savings get wiped out, and debt gets wiped out. Those three things. Right. So if you can acquire hard assets, if the currency gets devalued and the rents increase as a result, now the shorting of the dollar, you puts you on the right side of history, because that debt that you purchased 25 years ago is now worth a fraction of what it was worth when the note was originally written. So you get the benefit of the principal pay down on your amortization, but you, more importantly, and this is a much bigger fact and it's rarely modeled, that those dollars are worth a whole lot less than they were when you wrote that loan.
Right. That's what builds great fortune in real estate. It's the devaluation of the fixed dollar of debt over time. So that makes total sense. But most of the projects that people invest in, do have specific sort of a return economics, unless you're buying like Warren Buffett to own forever, and that makes total sense. How do you obviously value add is a critical component, or a forced appreciation is what we invest in heavily, and a lot of other investors, they want to see value creation through the labor of the operator or the sponsor. And what are the kind of returns in that industry you're seeing today? Well, what are returns on these investments in a 2-3 year cycle? Because the other couple of things you mentioned, the devaluation of a dollar, which is pretty obvious and common, especially with what's happening in the with the monetary policy today, and all the government action with massive stimulus packages and so on. And then the other part that of the inflation that you mentioned, the specific area inflation, the city, the town, the economic development of that locale is almost given. But the key part is, let's just chat a little bit about the forced appreciation. So what do your projects typically look like? Do you take external investors? What numbers typically, what is a good example today of some of your recent projects? What do investors make on their on their buck, assuming very conservative expectation of general inflation that rises all boats, and dollar devaluation? What kind of returns do you want to see when you do a project with a conservative investment philosophy?
Yeah, we generally don't put a very aggressive financial model when it comes to future inflation contribution. We won't model it as zero necessarily, but we'll certainly look at the zero scenario, but we know that it's not zero. So we'll model a few different scenarios going forward. We'll typically, even today, still use that classic 2-3% rent growth type model and an expense growth type model. When we talk about rent growth and expense growth, we're really talking about inflation. We're talking about devaluation of the dollar. So, the Fed is talking about averaging 2%. I mean, nobody believes it. It's well above that. We know that. So then, we're typically targeting for IRR, internal rate of return, in the hands of the investor as a minimum in the mid to high teens, maybe in the mid 20s, just to have what we would consider to be a viable project. That's hard to do in today's environment when you are chasing opportunities and there's too much money chasing too few opportunities, that so-called auction environment. Any multifamily project of any size, if it appears on the market, there'll be 20, 30 bidders on it, and the winning bidder will pay too much. So we would prefer to stay out of that auction environment where at all possible, because we don't want to pay too much. Now, those people that pay too much, they're banking on the fact that the future is going to unfold in a certain way, which of course we don't control. We would rather than going out finding deals, we'd go out and manufacture them out of thin air, out of a concept in our own mind, because there's no competition. There's no auction for the idea in my head or yours. That's off market, 100% off market. So you can see a property, you can envision a transformation. There's no flashing red light on it saying, I'm a deal, come get me. I'm not really a piece of farmland, I'm a hotel, for example, or I'm not an infill lot, I'm an apartment building. There is no such thing like that. So you've got to be able to envision that transformation. And if you understand the market dynamics well enough in that submarket, you can often create a tremendous amount of value, especially if there's a special circumstance surrounding that property. Maybe that property was tied up in litigation, or maybe that property was tied up in, who knows, maybe a tax lien, or any of a number of different complexities that make that property perhaps unattractive to others, but maybe there's an opportunity to do a land assembly with 2 or 3 properties next door. Individually, the property's worth next to nothing. Put 2 or 3 together, and now you have something of substance. All those types of things that, again, are not readily available to the naked eye.
Diamonds in the rough.
Yeah.
Understood. And on the deal creation, are you looking to, so just to, uh, on the basically new construction, the things you're developing today, you mentioned in Boise and Carolinas, what typical cost to value are you going in? So total cost versus a future value as a percentage, or give me an example. Just curious what these projects look like, because it's competitive. A lot of people are building, and they're all building with the assumption of certain values. Typically, looking at the comps, but the commodity inflation continues to escalate these kind of going in costs. So I'm just curious to see what numbers are you getting today on the cost to value of these ground up projects.
Typically, for example, if we're building say a 240 unit apartment complex, that project all in, including land, hard cost, soft cost, that might be about a $40 million project. If we've done our numbers correctly and we understand the market dynamics, you get a certain dollar per square foot in rent, maybe $1.50, $1.60 a square foot in rent, that property will probably value somewhere in around 52 million. And so you're creating, $10-12 million worth of value creation over, maybe a 3-4 year period. It's not amazing, but it's decent. It's decent. It's predictable. It's in your control. And that's one of the things we like about that. It's, you're buying at a discount to the market. You're building at a discount to the market. And then, of course, when you layer inflation on top of that, the future often turns out to be better than you anticipated. And it doesn't matter. I mean, your listeners might be thinking, well, I don't have the money to do a 240 unit project. The math is the same. Did a whole bunch of buildings in Philadelphia, in North Philly, that were sometimes only 10 or 12 unit buildings. These were $1 to $2 million projects. And it's the same math. In fact, we had a project on a very rough street. It was maybe 6 blocks from Temple University. And this particular property was on the list to be condemned by the city of Philadelphia. And we went through a period of uncertainty of about a couple of years. And we had designed a nice 10-unit project for that particular site. And when we got through the whole period of uncertainty with the city, cost of construction had gone up from $88 a square foot when we started the project to $115, and it no longer made sense. The project didn't pencil. We'd basically be building it for what it was worth. That's like changing a $100 bill for 520s. You could do it, but what's the point? So we literally threw that entire design away. We had permit-ready drawings. We threw it out. Our architect found a loophole in the zoning code where if we put a green roof, literally grass on your roof to absorb stormwater, we could get a higher density calculation. We redesigned the building at 13 units, got a little bit higher density in that location, designed a brand new building, built it, took another couple of years beyond what we had imagined. And instead of breaking even on a project, we were able to get 39% lift between our cost of construction and the actual value. So part of that was reconceiving the project, but here's the other part that we hadn't taken into account. In that location, we had underwritten the project assuming rents of $1,200 a month. By the time that project got finished and we started leasing up those apartments, we were getting $1,450 a month. So when you do the math, value the project based on those higher rents, all of a sudden that 13-unit building was worth a whole lot more. So we were able to successfully refinance with permanent financing, a stabilized product, recoup 100% of the investor capital, and return the money to investors and have a successful project. It doesn't matter. It doesn't have to be a 200-unit project. And that's a project that was a screw-up. That project was a failure, so to speak, because we had this massive multi-year stumble in the middle of the project, and we were still, with a bit of persistence and ingenuity and creativity, able to pull it out of the fire into a successful project.
Yeah, it's a great story. Thank you for sharing. Yeah, it takes creative mind and solution solving skills to solve a problem like that, and dealing with the cities and zoning and politics involved, could be a big deal, and it's fascinating. But this trend, by the way, of redeveloping some of the older buildings, I mean, it's pretty big around the country. And working on another project like this with the gentleman in Hagerstown, Maryland, and it takes the approval of the mayor and all kinds of support, because you're right, the economics are not there without the government stepping in, or you're finding some zoning exceptions. Ideally, getting state and federal credits, and obviously whatever support from the city, because some of these older buildings, they are sore eye. They hurt the view. They need to be redeveloped, but without city incentives, becomes a tough. Mathematically, it's tough to make it happen. But you shared a great ratio. So 40 million all in with the future value of 52 million, which is 80% ratio, and it's a little bit on the tight side, in my view. But the inflation and the whole environment, by the time you're done, given the rents have gone up, even 10% increase in the rents, even 5% increase, because of a leverage, you can magnify the value quite a bit. So it's almost crazy that I don't remember the exact ratio. Obviously, it depends on the leverage and everything else. But a 10% increase in rents because of a leverage could imply NOI increase and 30% increase, because it's all profit, I assume, at the moment. Before you know, your $52 million building could be worth 58 million or 60, and now project like that becomes, I don't know, a home run versus a single. So
Absolutely. And look, there's many opportunities to increase value in a property. There's some low-hanging fruit that often is overlooked. For example, if you're buying an existing asset, a lot of people say, okay, I'm going to put washers and dryers in unit, and hopefully you don't have to upgrade the electrical to do that, and get an extra $50 a month in rent. And if you do the math on that, you discover that for maybe, under $1,000 in appliances, you're, increasing the value of that apartment by 20 grand or more. And then you multiply that across the project, and now you've raised your value by a few million. Those kinds of deals are great, but those too are sometimes heavy lifting. There's simpler things you can do. For example, there are many services out there today that will allow you to come in and become essentially your own internet service provider. So you can purchase your bulk internet capacity, including your TV stations, at a discounted price, and now you're reselling it to your tenants at about a $35 per unit margin, and the impact to your physical infrastructure in your apartment complex is next to zero. I mean, it's really, really quite low. And the build out is done by the internet service provider that you contract, and those can be great opportunities. You may not even put that in your pro forma as part of your initial project, but then that extra $35 a month can translate into significant value creation. And you can do this on new construction as well. It doesn't have to be an existing asset.
That's low-hanging fruit. That little bit of additional revenue is all added to the bottom line. I mean, that's basically management. It's a creative, efficient, effective management to maximize the property revenues versus kind of pushing the heavy stones. This is the easy stuff. It makes a ton of sense. Let's talk a little bit about sort of the outlook on the cap rates, because this is the other big variable that kind of impacts real estate quite a bit. And we are in a sort of inflationary environment. At least this is the general observation. And you can argue what's going to happen kind of in the second half of 2021 and 2022. But the momentum right now is on the inflationary side. Are you seeing the cap rates and the interest rates? Well, the long-term cap rates and the long-term interest rates, there's some level of direct correlation, although it's supply demand. People are paying lower cap rates because they got too much money and nothing else to buy.
Right.
But the interest rates seem to be somewhat climbing, and the Fed doesn't seem to want to do anything about it. Maybe they're letting them climb. So
Well, they can't. They don't really have control over that. They set the short-term rates,
right,
and they put the Treasury bills into the market. But at the end of the day, it's the market that determines the yield on those notes.
right,
They don't control that. So, for example, if we all of a sudden, because the U.S. dollar is still the global reserve currency. If you want to trade oil between Italy and Nigeria, you have to buy U.S. dollars to do that, even though the U.S. is not a party to the transaction. So there's need for U.S. dollars on a global basis that normally wouldn't naturally be there with any other currency. So if at some point you start to get major countries like Japan, Saudi Arabia, China saying, I don't want your monopoly money anymore, then a risk premium is going to start to be attached to those dollars. And in order to sell those bonds, it's going to have to be at a higher rate. It's just that simple. No country's immune to that. When you start to attach a risk premium to a yield, then it affects the bond price. So it's not in the control of the Fed at all. They can say what they want, but ultimately the market determines. And that's what we've seen, for example, with the rising yield on the 10-year U.S. Treasury over the last 5-6 months. It's been determined by the market. So if interest rates really do go up in the future, and if interest rates are kind of closer to the historic norms, north of 5%, 7, 8%, is it reasonable to be seeing cap rates below 5%? I don't think so. I don't think so, because you can't go out and buy new debt to buy those properties when the cap rate's lower than your interest rate, right? Otherwise, you're going to have to bring a tremendous amount of equity to the table in order to have positive cash flow. So I think that will ultimately create, if interest rates do go up, it'll ultimately create upward pressure on cap rates, meaning fall in values. But I think it will affect the poorest quality assets first. Quality assets that are locked into low interest permanent financing, assumable loans, are going to be able to ride that out. So for example, if you purchase a multifamily apartment complex, you have it rate locked into a 35 or 40 year permanent financing that's indexed to a 10-year Treasury yield, and it's rate locked for that entire period, and you can sell the loan it's an assumable loan, you can sell it with the property. Just the fact that you got a loan for, 2.8% attached to this 200 unit apartment complex, and there's still 30 years remaining on that loan, people will pay extra. They'll pay a higher premium, simply not just to buy the asset, but to buy the loan, because they can't go buy that loan today.
Yeah, that is a great example of what happens in some of the commercial properties with these assumable mortgages. Actually, I was looking at the other day at a deal where there's an assumable loan, but the rate is above the current market,
right?
Because it's from a few years back. And the reverse is true. People are paying less for that property with the assumption because they're getting debt that is higher priced, higher rate than the current market. So it becomes a handicap on the property. The property is sold now with this sort of above the market rate alone, and it forces a discount in the price as a result of this. It's like a a sick child, unfortunately. That interest rate in the reverse is true, as you said. If the rates go up and you have a great locked-in interest rate, it becomes not your sick child, but more of a super healthy child that is your shining star, and you're attaching it to the property. So
but in the scenario you described, you still, as the new buyer, always have the option to refinance, unless you're bumping into a prepayment penalty.
Why would you want to refinance if you have a debt at a lower interest rate? Oh, in the deal that I'm describing, yeah. But you got to pay substantial yield curve maintenance or prepayment penalty.
Yeah, exactly. So it's a question. Yeah, where are you in that de-escalation of the prepayment penalty, and at what point do you hit a crossover? I mean, often these prepayment penalties, if let's say it's a 5-year note, it might be 5, 4, 3, 2, 1. Maybe you're in year 3 of those 5 years. You say, okay, for 2 points plus an origination fee to get to a lower interest rate, maybe I'm better off.
That's right. Yeah, it's a cost to reward kind of trade-off. So Victor, I appreciate all the wisdom, and I really like your comments on the interest rates. That the Fed doesn't determine the rates, but the market does. And what's really interesting on that subject, I mean, we've seen in the past quite a bit of QE, where the Fed comes in and starts buying a bunch of paper to push the rates down, and they're not doing it right now. That they're sort of, well, not to the extent that we would expect. They're doing a little bit of that. I mean, they're almost hooked into that. They can't completely remove it. So they're keeping the rates in check by doing some of the monthly, that normal purchases, but they're not going sort of out of their way to push the rates down with the kind of a bigger purchases. But the Fed balance sheet, what's really fascinating, if you compare the Fed balance sheet to the total size of the bond market, there's still, it's less than 10% of the entire bond market. So the action can't completely, corner the market, but they can certainly impact if they want to. Sort of, that's, I don't know if you have any comments on that, and whether there's a will, but on a long-term basis, one of the major concerns, if the rates go up, I call it the grand conspiracy theory. Can the U.S. government afford debt service on rapidly growing national debt with the rates going up? That's one of the big questions. Any thoughts on that?
Yeah, absolutely. I mean, certainly governments have an incentive to keep interest rates low just for their health of their own fiscal balance sheet, because if interest rates go up, now it costs the government more to do anything, and they spend a larger percentage of their revenues just servicing the interest on that debt. So, they have a significant incentive to keep interest rates low. And they don't have to go up by very much before it becomes a runaway train. You just look at countries like Argentina, Brazil historically, Peru, Argentina, to say nothing, of course, Venezuela, Zimbabwe, and so on. So, today, I mean, you've got, what are the interest rates in Argentina? They're in the 30s. I mean, these are huge numbers. So it's out of control. It becomes very difficult when interest rates get high. So there's a huge incentive to keep interest rates low. So then the question is, if the economy becomes overheated and they want to slow things down, what other non-interest rate related regimes can they put in place to cool off the market? Could they say, well, I'll tell you what, I'm going to put a cap on every FHA loan. So I'm not going to loan, it doesn't matter what the interest rate is, I'll keep the interest rate low, but I'm going to put a, $400,000 cap on any loan. Well, that will cool the market. Or maybe, like what has happened in Canada, they say, well, we're going to force you to pass a stress test as a borrower. So even though the interest rate might be, say, sub 2% today, we're going to pretend that at some point in the future, interest rates might be 4%. So you have to qualify as if it was 4%, even though you're only paying 2%. So they set a higher bar to make it more difficult to qualify for that loan. Again, it has the effect of cooling the market without it costing anybody any extra money. There's things like that can be done. We haven't seen a tremendous amount of that yet across the United States, but I would expect that we'll start to see more of that as time goes on, as they look to get creative for ways to cool the economy without it actually killing the economy.
Yeah, great commentary. Obviously, there are other tools like the underwriting tools and debt to income ratios and the balance sheets and so on. But from the political will, I would say that we are in the reverse of that environment, where it feels like the government will only try to support home ownership, providing additional incentives. There's been discussion of additional first-time home buyer tax credits, and if anything, loosening up the underwriting. So it's more like it would be a good disciplinary measure. Unfortunately, the political will is not there.
Not there yet.
Yeah, so that's why a lot of indications that the market will continue to do what it's been doing, for the reason that almost the government wants to force this asset inflation and continue pushing it. To risk it gets that balloon blown up too much, so that when we revert to the mean, that becomes a very painful exercise. So, Victor, I greatly appreciate your wisdom. Thank you so much for coming on the podcast. How would folks get a hold of you? We are out of time. As they say, all good things must come to an end, unfortunately.
Right on. Well, I'd love to connect with folks. I'm the host of the Real Estate Espresso Podcast, a daily show 7 days a week. Wherever you listen to podcasts, you're sure to find the show. We're on more than 20 different platforms. So it's called Real Estate Espresso, like the Italian coffee. It's literally your morning shot of what's new in the world of real estate investing. I'd love to connect with you that way. Connect with me directly through my website at victorjm.com. That's victorjm.com. And thanks for having me on the show.
Thank you kindly for coming on the show.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.